Walk into almost any major Australian suburb, and you'll find one at the center of it. A shopping center anchored by a supermarket or department store, surrounded by dozens of smaller shops, all funneling foot traffic past each other in a carefully engineered loop. Some of Australia's biggest shopping centers pull in tens of millions of visitors a year and generate billions of dollars in tenant sales. It looks like one of the most powerful property plays in the country. Buy the land, build the center, and collect rent from dozens of businesses at once. But behind the scenes, owning a shopping center is a business built on incredibly high upfront capital, a rent structure far more complicated than a simple lease, and a slow but very real threat from online shopping that's reshaping how these centers make money. So how does a shopping center actually make money in Australia? Let's break down the economics. The first thing to understand is that almost nobody builds a shopping center from scratch as an individual investor. Construction costs for retail property have risen so sharply in recent years that new center development and even expansions of existing centers have slowed dramatically. And the total retail floor space across the average Australian shopping center hasn't meaningfully grown since 2019. What this means in practice is that shopping center ownership in Australia is dominated by a small number of large listed property groups, companies like Scentre Group, Vicinity Centres, and Lendlease, who have the balance sheets to fund $100 million to billion-dollar developments and hold them for decades. For most people looking to get exposure to this business, the more realistic entry point isn't buying an entire center. It's buying a strata retail lot within one, essentially owning a single shop inside a larger center rather than the whole building. Lenders typically require a deposit of 20 to 35% for one of these, based on a loan-to-value ratio of 65 to 80%, with total finance packages ranging anywhere from around $100,000 up to $10 million or more, depending on the size and quality of the tenancy. Whether you own an entire center or a single lot within one, the value comes down to the same core mechanic: tenant mix. Every well-run shopping center is built around at least one anchor tenant, typically a major supermarket or department store that occupies most of the floor space and, more importantly, drives the foot traffic that every other business in the center depends on. Around that anchor, the center owner curates a mix of smaller specialty tenants, food, fashion, health and beauty services, chosen specifically because they complement rather than compete with each other. Get that mix right, and you create what's essentially a one-stop destination that keeps customers on site longer and spending more. Get it wrong with too many competing tenants or a stale mix, and vacancies start compounding, because a gap in a struggling center is far harder to fill than a gap in a thriving one. Now, here's where shopping center economics get genuinely more complex than almost any other property type on this channel. A shopping center doesn't earn money from one simple rent figure. It's built from several layers stacked on top of each other. The first layer is base rent, the core amount each tenant pays for their space, often benchmarked per square meter and varying enormously by location, with prime Sydney CBD retail rents sitting among the highest in the country. The second layer is turnover rent, a mechanism fairly unique to shopping centers, where in addition to base rent, tenants pay the landlord a percentage of their actual sales once turnover crosses an agreed threshold. This aligns the landlord's income directly with how well the center as a whole is performing. If the center draws more shoppers and tenants sell more, the landlord's income rises with it. The third layer is outgoings, the recovery of costs like council rates, water, cleaning, security, and common area maintenance, typically charged back to tenants in proportion to the floor space they occupy. And the fourth layer is the marketing levy, usually calculated as 3 to 5% of base rent, which tenants pay into a pooled fund the center uses for center-wide advertising and promotional campaigns. Together, these four layers make up what's called a tenant's total occupancy cost. And in Australian shopping center specialty stores, this typically runs between 10 and 20% of a tenant's annual sales, sometimes higher in premium CBD locations. From the landlord side, this is the whole game, structuring occupancy costs that are sustainable enough for tenants to stay profitable and stay open, while still maximizing the total income the center generates. So what does profitability actually look like? For an individual tenant paying, say, $200,000 a year in total occupancy costs against $1.5 million in annual turnover, that might represent an occupancy cost ratio of around 13%, generally considered healthy. For the landlord, the return comes down to yield, the annual rental income generated as a percentage of the property's value, and center quality matters enormously here. A well-located regional center with a strong anchor tenant, high walk-in traffic, and long weighted average lease expiry across its tenants commands a premium valuation compared to an aging, poorly located neighborhood center with rolling vacancies. Now for the challenge every shopping center owner in Australia is navigating right now: online shopping. As more consumers shift spending to e-commerce for convenience and price transparency, physical retail centers have had to adapt, and industry-wide revenue for shopping center operators nationally is forecast to decline slightly over the coming years. The centers holding up best are the ones evolving beyond pure retail, adding dining precincts, entertainment, gyms, and lifestyle services that can't simply be replaced by a website, alongside CBD centers that have benefited as foot traffic rebounded strongly post-pandemic. So is owning a shopping center still one of Australia's great property plays? The fundamentals remain genuinely strong. High population growth keeps driving demand for well-located retail space, and tightly constrained new supply means existing centers, particularly the well-managed ones, hold significant pricing power. But this isn't a passive landlord business. It's active portfolio management, curating the right tenant mix, structuring layered rent agreements that keep both sides viable, staying compliant with retail leasing law that changes state by state, and constantly evolving the center's offering to stay relevant against a retail landscape that increasingly lives online. The operators who win in this business aren't the ones who simply collected rent. They're the ones who treated the shopping center as a living, curated ecosystem that has to keep giving people a reason to walk through